So for the next 15 minutes or so, I will give you an overview of African hotel performance. We'll start off with a brief look at the globe, drill down and look at Africa, some of the key cities. We'll then do something a little bit different and take a bit more of an in-depth dive into 5 key cities, hopefully in about 5 minutes, and then finish with a look at supply and finally pipeline. So I'm sure you're all aware, but for those of you that aren't, STR, we are the market leaders in hotel performance data. We're now working with more than 58,000 hotels across the globe and just shy of 8 million hotel bedrooms. So this first slide is a slide I'm sure a number of you will be familiar with. It's our global supply and demand percentage change for August year to date. And please note that all of the data that I will present today will be August year to date. So from a demand perspective, we can see demand is up across the world, quite consistently across all regions, but leading the way is Asia and then Africa. From a supply perspective, unsurprisingly, it continues to be the Middle East, which has the most growth, and then followed by Asia. The Middle East is one of 2 regions as well where supply growth is outpacing that of demand, which naturally leads to negative occupancies. When we look at the supply and demand equilibrium for Africa, however, we've got a healthy fundamental picture, with supply up 1.4%, but demand rising this year by 5.7%. So how does that then affect our global RevPAR map? Well, we can see those 2 regions which had declines in occupancy also have declines in RevPAR due to pressure being put on average rate. There's one standout number there, as you can see, which is for Northern Africa. 41% growth. We can really put that down to, yes, some recovery, but predominantly that is down to the devaluation of the Egyptian pound. Southern Africa, 4.3%, a fairly healthy picture. So let's now drill down and have a look at Africa in a little bit more detail. And it's obviously difficult to talk about the continent as a whole, so I'm just going to do one slide on Africa as a whole, where we can see that occupancies this year to date are at 56%, average rates $103, so a decent growth there, and then a 14% increase as well. From a RevPAR perspective, up to $58. Now, where things get a little bit more interesting is when we drill down and look at the individual markets. And this is RevPAR percentage change for this year to date, as mentioned. And we've got a real mixed picture across the continent. So if we start in the north, first of all, we look at Egypt. We've got some significant increases, which Alex referenced earlier. But it is really very much driven by that currency devaluation. If we look in US dollar terms, Sharm el-Sheikh is up 6% and Cairo is actually down 9%. So you can see just how impacted by currency those figures are. Tunis, having a bit of a recovery. Obviously, there's been a difficult few years for that country, and also some visa changes that were referenced earlier today. Those visa changes also helping in Morocco, where we see growth, and we have a little bit of an increase in Algiers as well. Moving to the west, Lagos, it's a decent increase, but again, that's partially down to some devaluation of currency. If we look in dollar terms, it's down 10%, but we'll look at Lagos in a little bit more detail as well. Accra, doing fairly well. Also, oil outputs, revenues up across Ghana, and certainly helping things. If we move to the east, Addis, well, that's actually quite a strong performance. It may just look like 1%, but supply has been up 4.2%. So taking that into account, it's a positive picture there. And then we enter a whole swathe of markets where we've seen some declines. So Nairobi, again, we'll look at in more depth, but that's very much been supply driven. Dar es Salaam, business environment, government regulations certainly not helping things. Struggling economy in Mozambique, although as we saw from Daniel, certainly one to watch in the future. Lusaka, there seems to be a bit of a race to the bottom in terms of rates. Actually, occupancies and demand is pretty solid across that market, but significant rate declines. And Harare, well, all things considered in Zimbabwe, not too bad a picture really. Gaborone suffering from demand declines. And then we see in both Durban and Johannesburg, we've got some slight declines due to the domestic economic situation as well as airlift, which was touched upon earlier. But Cape Town remains positive. Leisure performance there, the weak South African rand, driving that double-digit growth there. And also Windhoek doing well, and especially impressive considering the Hilton Garden Inn opening there, adding 180 keys into what is a relatively small market. But how does that then translate when we look at actual performance? So this is the same cities, and they're ordered in terms of occupancy. And you can see Windhoek, which I mentioned earlier, 67% occupancy, the highest of the markets we're tracking on the continent. And then we can see Cape Town, Durban, and also Casablanca at over the 65% level as well. From a rate perspective, Addis, high-end supply in that market, certainly a deciding factor, but $213. That's followed by Accra on 167. One other thing I think to mention when we're talking about rates here, Maputo, Marrakesh, and Algiers, all over $150, and all ahead of Lagos. For many, many years, Lagos was the highest performer in terms of rate across the continent, not any longer. Let's now drill down and look at 5 cities in 5 minutes. And we're going to start in the north, and we're going to start in Cairo. Now, this chart, I think, quite nicely illustrates the challenge from an occupancy perspective, the geopolitical situations that we've seen across Egypt have had on performance. Going back to 2011, we had the revolution, 2013, the insurgencies, 2016, the riots. You can see immediately the impact on performance of those situations that occurred. And you can also then see, when you look at that green line, the sharp increase in rates late last year due to the devaluation of the Egyptian pound. But the good news is we can see in the latter half of this timeline that occupancies are at that higher level. Although they are still fluctuating, we're looking at a higher level, generically speaking. And then this is our compression analysis for Cairo. Now, some of you may be familiar with our compression analysis, but I'll just take a minute to explain it for any of those that this is new to. So what we do is we look at every night of the year, and we look at the performance, and we put that performance into an occupancy bucket. So in this situation, it's either 50% or below, 50 to 60, 60 to 70, or 70% and above. And where we get into those higher occupancy buckets is what we call our high compression nights. And then we can see the corresponding dots refer to the average rate that has been achieved on those nights. So you can see here at Cairo a recovering market. You can see over the last 3 years, we've seen a decline in the number of nights that were sub 60% and an increase in those that are above 80. Now, bearing in mind, of course, that percentage, it's a bit misleading, candidly. We're only talking about 14 nights where occupancy has been above 80%, but nevertheless, we are seeing that recovery. And again, you can see the devaluation in the way that the average rates have jumped so significantly in this year. Cairo does remain, however, very much a corporate market. And again, we can see this when we look at our day of week analysis. Although rates remain remarkably consistent across every day of the week, we can see that occupancies do very much peak midweek, with Wednesdays being the high point. Moving across the Maghreb then to Casablanca. And again, our compression analysis. And we can see again a recovering or improving market, with the number of 70% room nights declining and the number of 90% room nights increasing, up to 21 this year to date. So high compression nights are on the way up. But what you do notice is the average rate premium that we see between those lower nights and the high compression nights is not particularly significant in what we would see in a market that is performing at higher levels. And we'll see that in a moment, because ultimately the pricing power is not always with the hotels due to those occupancy levels. And once again, just like Cairo, Casablanca remains very much a corporate market, and you can see that with the day of week analysis, again, consistent from a rate perspective, but highs on a Tuesday and Wednesday when it's over 76%, so strong corporate demand in that market. And I thought it'd just be interesting to add Marrakesh into this equation, obviously the leisure capital of Morocco, and what we can see here is a polar opposite, where Friday and Saturday nights, from an occupancy perspective, are highest, obviously benefiting from that weekend business. Moving to sub-Saharan Africa and Lagos. Now, a lot has been spoken about the oil price, and this chart shows the correlation between the oil price declines and then the occupancy that we've seen over the past 5 years in Lagos, as well as the average rates. And you can certainly see the correlation. If we go back to 2013, Lagos was trading at 60% from an occupancy perspective. In 2016, 44%. Now, of course, supply growth has played a part in that, as has political safety concerns as well. But ultimately, oil has certainly had an impact there, and you can likewise see the US dollar rates decline accordingly. But one piece of good news is we've seen a bit more of an uptick when we look at that compression analysis for 2017 anyway. You can see the number of 40% and below room nights has declined sharply, and the 60% and above has grown. But do bear in mind, look at those buckets. We're looking at less than 40%, more than 60%. The market's trading at 50% at the moment. So again, not that strong. And again, you can see that the average rate premium on those higher compression nights is not too strong either. Moving to the east and Nairobi. Similar chart to that we saw in Cairo. Again, geopolitical circumstances, terror attacks, elections, as David mentioned a moment ago, all having an effect, and you can see how occupancy reacts as a result. The turquoise line here, though, refers to supply growth, and that has been a massive challenge for Nairobi. Last year, supply was up 9.7%. This year to date, it's up a further 9.4%. So you can see supplies continue to tick up as we go across the years. And that's very visible in this compression analysis, where you can see the number of nights below 50% is up, and the number of nights above 70%, is down. And again, average rate premiums not strong as a result of the fact that the market is just not selling out. Onto a market which is performing better, however, Cape Town. And the compression analysis here is good. So we can see we've seen a fall in those lower room nights, and we've seen an increase in the 90% and above room nights this year to date, quite significantly. And because the market is consistently achieving those higher rates of occupancy, what we're seeing is revenue managers really pushing rates, and that's why we've got that 50% average rate premium, where they really are pushing rate when demand is in town. And we can see again the demand into South Africa. This data is overlaid on our occupancy figures is from our friends at Tourism Economics, where their figures show that for the first 8 months of the year, we actually saw more arrivals into South Africa than we did for the entirety of 2016. And also you look at the occupancy levels, that's without the strong last 4 months of the year. December, obviously, a very traditionally strong month for Cape Town. So performance is looking fairly robust across that market. Now, I'd just like to change tact and have a look at the supply picture. And this is a chart I first presented last year, where it shows just how much branded supply in terms of the number of rooms there is across the African continent. And as you'd expect, it's dominated by the usual suspects. So we've got Egypt, Morocco, Tunisia, South Africa, etc. But what I think is quite interesting is when we start to compare things internationally, Egypt is the only country across Africa that appears in the top 20 countries globally when it comes to branded supply. And again, when we compare internationally, Fiji and Aruba have more in branded supplied rooms than Algeria. Iraq and El Salvador have more branded hotel rooms than Ghana, and Montenegro and Trinidad and Tobago have more branded hotel rooms than Ethiopia. So once again, it shows the wealth of opportunity that is still there from a branded supply perspective. But it has come along. So this is a chart for those people who have attended AHIF over recent years will be familiar with. This is what I presented, first of all, back in 2014, when we had 12 countries across the continent where there was no branded supply at all, and a further 6 countries with only one African brand present. If we fast forward to today, it's a changed picture. We've got 8 countries with no branded supply and only 3 with one African brand. So the increase in footprint from the international chains as well as the African brands, very apparent from these charts. And I'd like to just finish by looking into the future a little bit and looking at pipeline. Now, this chart shows the percentage that existing supply will increase if all of the projects in the pipeline come to fruition. So we've got two standout numbers, really. We've got Europe, just 4%, very little new supply coming in. The Middle East, a whopping 50%, huge amounts coming in for a market that's struggling already. And while Africa sits nicely in the middle at 11%, pretty much in line with the other regions, as you can see there. According to our pipeline, and obviously we'll hear more from Trevor shortly, but up until the end of next year, we expect a further 22,000 keys to come into the existing supply across the continent. But where are those rooms? Well, despite all the challenges, Egypt does remain the hotspot for pipeline and development across Africa, 8,500 keys. That's followed by Nigeria on 6,600, and then a bit of a drop down to Angola. Obviously, largely Accor dominated that pipeline with 5,000 keys. In terms of cities, Addis Ababa has the largest pipeline of any city in Africa. We have 3,500 keys in our pipeline. There are 19 internationally branded hotels in the pipeline in Addis at present. We then see Nairobi. Obviously, we've seen the plethora of new supply that's come in. That will continue, a further 3,300 keys in the pipeline. And then we've got Lagos, Sharm and Cairo, all with more than 2,500 keys. So we've covered quite a lot there. I hope it was of interest. I'll be around for the next day or so if anybody would like to discuss further. And with that, and if anybody also would like a copy of the presentation, please don't hesitate to let me know, and I will be happy to share. And with that, I'll say thank you very much indeed for your time and introduce Trevor Ward. Thanks.